Hey everybody, this is Brian Shannon from AlphaTrends.net. Today is April 23rd, and tomorrow America's favorite company, Apple, is reporting earnings after the close. So I wanted to take a look at the technical analysis. There's obviously a lot of great fundamental things going on with Apple, but the stock's gotten a little bit, trading in the stock's gotten a little bit nervous, I guess you could say. It's down about 10% off its highs just about 2 weeks ago, but still up significantly year to date. And when we look at a longer term, like a weekly chart, it's really taken off this year, and the pace of the ascent has really accelerated. We have seen it pull back, though, obviously, here, and it's down right on this 50-day moving average. For those that aren't familiar with moving averages, it's just the average price, closing price, that is, of the last 50 days, and it tends to act as support in an uptrend. What we see before that a lot of times, though, in an uptrend, and what I have on here is a 10, 20, and a 50-day moving average, is early in those uptrends, we'll see the 10-day moving average act as support. The pullbacks get a little bit deeper, then it's the 20-day moving average. And when the 20-day moving average fails to hold like it did this time, a lot of people, kind of get a little bit panicky, and the stock pulls back a little bit deeper. Now we've seen it pull back right down through and close pretty much right on the 50-day moving average today. The 50-day moving average is 570.76. Now a lot of people look at those as a literal number where you need to buy the stock. I like to look at them as an important level to monitor the activity on a shorter term time frame. So for instance, if we take a look at a 65-minute time frame, and I like a 65-minute time frame because the market is open for 6 equal lengths of 65 minutes each day. That is from there's the 9:30 to 4 p.m. session. There's 65-minute periods, each equal to six. Six 65-minute periods. If you're using 60-minute candles, we would be looking at 7 candles per day, and one of those candles each day would be 30 minutes. That is the 9:30 to 4 o'clock. Anyways, what we have on here is a chart that takes a look intraday of these 65-minute candles using a 5-day, 10-day, and a green 20-day moving average. So we can see that we've sliced through those moving averages, and the 5 and 10 are now heading lower. What we see, the line that I've drawn in, and I'll just redraw it and bring this trend tool over here, which by the way is Realtick, the trading platform that I look at in the charts here. So if we remove that and go from the January 3rd, the first day of this year, and you can see that my pencil is up here, but look down below where that line is drawing across. What that's doing is taking the average price that the stock actually traded at. So the average price year to date, and let me just do that again so you can see the number fill in that box below, just under the clear all. You can see the average price year to date is approximately $546. So what we also notice down in that level is on the right hand side I have the volume by price. Now this volume by price shows where the supply and demand, where shares traded hands, that is where there was prior turnover in the stock, and they say stock or price has memory. There's a lot of volume associated with a certain price level. It will tend to act as support. So if we see Apple pull back a little bit deeper after reporting earnings tomorrow, I think that down near this volume weighted average price for the year to date of 546 looks like a reasonable place where the stock might be able to be bought, because we also see that here we had big turnover in there as well, and that prior resistance will tend to act as support. So resistance broken will tend to act as support on a pullback. And now what we see, though, however, on the other side is we can see that there's not a lot of room up till about 600 or so. That is, there's not a lot of big shares traded, but between about maybe 585 up to 610, there was a lot of volume that changed hands up there, and this prior support area as well. So that has the potential, I think, to offer some resistance. We're going to have to see a really big reaction to earnings in order to chew through that potential for supply. And the psychology behind that is that a lot of people purchase the stock up above $600 a share, and here we are, they're down 5% on it or so, and they might not be panicking, but they're maybe questioning the intelligence of buying at that price now that they're down, and they might be looking as you would often look to. Let's say if you bought a stock at 600, it drops to 560 in a couple days, you'd be thinking, well, wait, the stock is up this huge. I'm on late now. If you can just get me back to break even, and then at that point I'll sell it. And anyways, that creates a source of supply for the stock. One other thing I want to take a look at is some Fibonacci levels, and that's just basic retracements. If we take a look at, since this rally really kind of kicked off, we could either measure it from this low back in November of last year, or I think it's probably a little bit more accurate to say this is where this leg really began its move. So what this is doing is saying if it was to pull back a normal 38.2% retracement, that would bring us down to about 545 right in here, and that's this level that I just drew my line over by accident. Anyways, what this is telling us is that a lot of times we have buyers at a 38.2% or similar type of Fibonacci retracement level, where it's the 38.2%, the 50%, or the 61.8%. That often attracts new buyers to the stock. Just like a 50-day moving average will tend to stabilize a stock, and it'll attract new buyers. Or on the flip side, there will be people who are selling the stock that say, wait a minute, it's down to 38.2% retracement. I'm not going to sell anymore. So there's less supply, and there might be a new source of demand based on that Fibonacci level. Well, we also might see a new source of demand from people who are saying, well, that looks like a solid level where shares have traded hands in between that year-to-date volume-weighted average price of 546 or so and this prior big level of turnover in here. So basically, the point I'm trying to make there is that it appears as though this 545 to about $550 level should be in a level where the stock, I think, should we see it pull back a little bit further in front of earnings, that would be a likely area where it does bounce from, and perhaps up to 600 or so. But the stock has gotten extended longer term. It's definitely not new to the new high list. If you look at this, for instance, going back to 1995 or so, it's really taken off the last few years. It doesn't mean it can't continue to do so, but it appears to me the stock probably needs some more time to digest these large gains of this year. And I think between 550 to 600 would likely be the range for a bit of time in here. Let's see how the earnings report goes, and try to, if you're trading it, trade what you see, not your opinion of what the news is. But be aware of those key levels where it has the potential to find support or resistance, and don't be chasing the stock if it rallies up to $600 a share. Let it settle back down. If it sells down to 550 and you feel like putting a little skin in the game, that appears to be an important level that should hold, and maybe you set your stop at about 540 or so. Either way, good luck if you're trading Apple, and thanks for taking a look at my analysis.